Hello, everyone. Today on the final bar, I'm talking to Katie Stockton from Fairlead Strategy. We'll review some of the charts that are top of mind for her. Overall, the market in pretty serious distribution move going into the close, really accelerating to the downside. We saw a bit of that yesterday. We saw in a much bigger way today with the S&P closing just around 4480. What does this mean with this short-term distribution relative to the long-term trends, how they've evolved? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment, particularly using the language of technical analysis, using indicators based on price, trend, momentum, breadth, sentiment, all of that good stuff to better quantify investor decisions, investor psychology, and how they manifest themselves into price action. If you're trying to draw some behavioral conclusions from today's trading day, from yesterday's trading day, certainly distribution, while there was choppiness and distributive patterns through the course of each of those trading days, the moves lower into the close really tell a lot. And there are times, I feel like over the last year or two, I remember a number of days in particular where you just felt in the last 30 to 60 minutes of trading, everything start to rotate lower and just, sell off. And it's basically the clock saves the day because the market is just not going to stop going down until the close. And that usually, of course, tells you that there is a lot of, or implies certainly a lot of institutional selling going into the close, right? That last 30 minutes of trading is usually institutions, it's big funds rotating positions, it's big flows that are coming in or out, and the distribution that you saw on a day like today, certainly not what I would bucket under bullish sentiment. It was interesting thinking about the trading day. When I first looked at the market in the first hour or so, it was all the growth stuff at the top of the list. It was technology, communication services, consumer discretionary. All of that finishes much lower. And, even just midday, you saw things like utilities, energy rotating back to the upside. And the end of the day, utilities, the only one of the 11 S&P sectors finishing in the green. Lots more to come on that. We have a great show set up to try to make sense of these things. Couple great guests we have coming up for you. Katie Stockton is joining us on the show today. I'm super excited for that. Always a great conversation. Next week, we have Chris Shavako from Shavako Capital on Tuesday, the 25th. On Wednesday, joining us from Chicago, we have John Kosar from Asbury Research. A couple other good events to give you a heads up on for next week. On the 24th, the guys at Go No Go Charts, that's Alex Cole and Tyler Wood, recently added their proprietary indicators onto the StockCharts platform on our ACP app store. They will be doing a special event on Monday the 24th, sharing this new plugin, their methodology, and how to think about it. Should be an interesting way, a different visualization, actually, a really unique way of visualizing trend and momentum. Also next week on the 26th, we have our latest episode of The Pitch. I will be hosting a conversation with Joe Rabel from Rabel Stock Research, Mary Ellen McGonigal from MEM Investment Research, Jay Woods, Chief Market Strategist at Drive Wealth. It's a really fun show. We have each guest give us 5 stock or ETF ideas, and then we discuss them as a group. It's really good, cool opportunity to get some really knowledgeable market practitioners together, just debating some of the ideas of the day. So go to stockcharts.com/thepitch for more information on that event coming up next week. Let's continue on today's show with our market recap. So the 2-day preview chart, I think, tells you a lot of what you need to know about the short-term sentiment, right? Sellers outweighing buyers, selling pressure outweighing buying power, however you would want to describe this pattern. That's what we're seeing. I tend to talk about the markets in 3 phases: an accumulation phase where the market's going higher, a consolidation phase where we're going sideways, a distribution phase where the market's rotating lower. And that can be applicable to any price series, to be honest with you. And you're certainly getting this sense as the S&P fails to hold its 50-day, now fails to hold its 100-day, getting below 45.50, which is an established level of support. It's hard to think too optimistic about what we're seeing here, particularly today where you see a big rotation out of offense and into defense, if I would generally summarize the trends that we're seeing here. At the end of the day, the S&P finishing down 1.1%, the NASDAQ composite, a little more than that, 1.3%, mid and small caps pushing even further down, 2.1% for the S&P 600 small cap index, and the VIX, which was below 20 not too long ago, now above 25, which puts it in a relatively small number of observations if you look back since the March 2020 low, particularly since things settled in 2021. Very rarely we've gotten above 25 on the VIX. It might be an important chart to look at and review. Other asset classes here very, very quickly. Interest rates, it's kind of chopping around. The fixed income market chopped around quite a bit today. Interest rates finished a little bit higher with the 10-year yield finishing around 183. The dollar index continuing to push higher. That's been the story for the last couple of days for sure. The UUP up 0.3%. Other asset classes, gold was actually in the green earlier in the day, but finished weaker through the course of the day. The GLD was down 0.25%, but silver, copper prices higher. Commodities as a whole coming off pretty well in the last couple hours, as you see from the chart of the DBC. Finally, cryptocurrencies to the upside. If you're looking for green, you can look in crypto land here. It's interesting. There's a bit of a disconnection when you think about cryptocurrencies as a general measure of speculation or a general measure of risk on versus risk off. But if you look at the last couple hours, you can certainly see that Bitcoin, Ether, and most of these were much higher earlier in the day and rotating lower in concert with what we saw from stocks, the S&P and the NASDAQ. Looking at a chart of the S&P 500, so I added the 100-day moving average in here. That's that green sort of dotted line in here. We usually have the 50-day in blue, the 200-day in red. I've been tweaking this as I always seem to do, just cleaning things up and reflecting where I'm seeing some opportunities. I sort of cleaned out some of the shaded areas because they're levels much further down. The fact that I just today removed some of these deeper support levels may be the signal that the trend is going to start getting really negative because I took some of those lines out just to clean up the chart. But it's interesting, people, I've been talking about the 50-day moving average. I think for much of last year, that was the story. That was the game, was just watching for pullbacks to the 50-day. And it just was this consistent, fairly consistent uptrend. What's happened now since we broke to a new swing low today, a couple interesting things have happened. We've cut below 45.50 and I think follow through. We closed below there yesterday. And when we did, what we talked about on the show was looking for a follow through day, right? Anytime you break a key support level or a key resistance level, it's all about that next day or two, right? Do you see that follow through, that confirmation of that validation that the breakdown or the breakout is confirmed, is valid, there's more momentum where that came from. And I think today's session, you're certainly seeing that sort of pattern. We've now undercut 45.50. We're now closing below 4,500 for the first time since last October. This is certainly a market in distribution mode. This is now, eclipses the deepest drawdown that we saw in 2021. 6% was the deepest pullback we've had. We're now over that. So we're now seeing a 2022 that's a little different than what we saw last year in many ways. The other, what happens when you start breaking those levels? As always, we look for other key levels to pay attention to. What are the next levels of potential support? 200-day moving average currently around 44.30 certainly could be an interesting one. As you can see, we've been nowhere near the 200-day moving average for quite some time. I think the last time we touched it was back in 2020, certainly, and I would imagine it's at the 2020 lows, right around that period when you undercut the 200. From there, we've pretty much been above it that whole time. Below there, 4,300. That's actually the level of support from last September and October. So certainly some potential support below where we're at, but I'm more concerned by the not just the price action, the weakening breadth and other things, which hopefully we'll get to. We have a segment later in today's show called Getting Sentimental. We're focused particularly on some of the market sentiment indexes, and I think you might find some interesting indications there as well. Just to finish off our discussion on a market recap, and I've often said on the show, there are some times when I feel like there are plenty of things to talk about, and other times where not so much. This week has certainly been the former. I feel like there's so many things we could touch on. I'll try to get on as many as we can. We haven't looked at this breadth chart too often recently. This is the cumulative advanced decline lines. And the last time I updated these colors, I had half of them in green because they both broke into new highs going into year end. This is the large cap breadth index and the mid cap breadth index. And these are the cumulative advanced decline lines for each of those indexes. But if you look at the NYSE advanced decline line, actually made a lower low November into January. Small cap AD line making a lower high, from November into January. So you have this divergence, right? This divergence where the market's going higher, but some of these breadth indicators are actually making lower highs. Makes me think of the RSI, the main measure of momentum that we talk about for the S&P 500, making lower highs over that period as well. So we've certainly seen some signs of dislocation or signs of weakness. The percent of stocks above their 50-day moving average for the S&P 500 undercut 50% yesterday. This isn't updated for today's close just yet, but I would assume that that's going to go even lower given the sell-off that we saw going into the close. So it's going to be below 45%, which now puts it in a relatively small list of observations, which were the major pullbacks after the March 2020 low. Last thing I wanted to hit on was this one. We're now getting very close to the bullish percent index, getting below 50%. When I interviewed Mark Chaikin before the holidays, we were talking about this particular indicator, and he highlighted it as one of the best indicators over the last couple of years. All you need to do, life is easy as an investor on the S&P 500. All you need to do is look when the bullish percent index undercuts 50%. That seems to be a pretty buyable dip. And for the most part, that actually played out very well. We're getting near those levels very, very soon. And again, I think back to comments from one of my mentors, Greg Morris, who said all new highs are bullish except for the last one. The challenge with that thesis is the time it doesn't work. And the big red shaded one you have right here was when we broke below 50% and then just stayed below it for another 4 or 5 weeks. That's what could happen, right? That is the possibility when you start seeing a market sell off as a buyable pullback, a buyable dip turns into something much deeper. So I think now is a really good time to be focusing on key levels of support, focusing on breadth indicators, and also on a lot of individual names. Hopefully after the break, as I talk with Katie Stockton, we'll get some ideas of which names we may want to be focusing on. Back with Katie Stockton in a moment. We'll see you there. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we break down the market activity using the power of data visualization techniques, using stock charts to understand the message of the markets, price, trend, momentum. A couple comments before we get to today's guest, Katie Stockton. First off, we welcome your questions. We're here to help point you in the right direction. Our email is the best way to get your questions to us, thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts channel. We'll gather all those questions and hope to answer one of yours in our next mailbag segment on Friday's show of this week. Also, go to StockChartsTV.com. That's our on-demand platform. Great events like The Pitch, our special market outlook events with Martin Pring, Larry Williams, so many more in January, our year in review from December, and all the great daily and weekly shows that we have on demand for free. You go to StockChartsTV.com, use your email address to set up a free account, or just on your app store on any of your mobile devices, just search for Stock Charts TV on demand. I want to welcome on today's guest, Katie Stockton. Katie's the founder of Fairlead Strategies, coming to us from Connecticut. Katie, Happy New Year. Welcome back to the show.
Same to you, Dave. Thanks so much.
So it's been a fascinating year so far. The year is still pretty young, but we've seen obviously a lot of rotation. One of the big challenges I think a lot of people are starting to recognize are the changes in the interest rate environment and Fed policy. You're starting with the chart of the 10-year yield. What is this telling you?
Well, there's clearly a breakout above that resistance level from last year, which was roughly 178. And notice that it aligns with the 50% retracement. That's a Fibonacci retracement level, above which we get to about 213 as the next targeted Fibonacci level. So once this breakout is confirmed, meaning you post a couple good solid weekly closes above 179, the targeted level does become that 213. And I think just importantly, it affirms the uptrend that you can see there in the shaded portion of the chart, which is the cloud model. it affirms that is still very much intact. And it almost even has the shape, I'm sure you can see, of the cup and handle, right? Yeah, big sort of rounded base, and then a shorter term one that we have now, the breakout from, on improved intermediate term momentum. So the indicators shown below, the stochastic oscillator and MACD, both support that breakout. And I just think once we clear that 2% level, that's a psychological hurdle. So for any doubters out there in terms of the direction, I think once 2% is cleared, they're going to have to sort of embrace this move.
And I love you very graciously included the couple years before that. So you can see that rates can indeed get much above 2%, right? When the trend is in place. Yeah. Your second chart with the volatility environment, I was told the VIX hits 20 or 25 and that's it. But now we're starting to break out above there. What are you seeing on the volatility side?
Yeah, so I think importantly, we see volatility based on the VIX move in cycles, longer term cycles. And we've certainly been in a low volatility cycle with a floor around 15 for the VIX. The setup, I wish I had a little bit more history on this chart, but is somewhat reminiscent to early 2018, when we'd spent 2017 in this kind of low volatility cycle, and then pushed through what was resistance that was very similar in the way it sets up, with a gradual down trend line, sort of lower highs in that VIX, and then also the cloud shows resistance roughly 28. So once we see a move above that level, irrespective of the short-term implications of that spike, which of course would mean we're seeing downside from the major indices, which are inversely correlated, it would suggest that we're getting into a higher volatility regime. So perhaps the new floor becomes 18 or even 20. But what it tells us is that this year could be a lot like 2018 in its character.
2018 certainly a choppy year with a couple, decent drawdowns during that calendar year. Your right. Next chart is, we talk about higher rates, and the potential for that certainly tends to be a headwind for growth stocks. Now we're looking at the DeMark. I believe this is TD sequential we're looking at.
This is actually TD combo, but okay. Same takeaway essentially. And I think the important thing to note here is that this DeMark sell signal denoted by the 13 above the price bar, we haven't had one throughout this up move off the COVID low in 2020. So there are often false signals on the short-term charts, of course, when we have the markets in a bull market like they have been. But these monthly signals are somewhat infrequent. And the last one on both the NASDAQ 100 chart you see here and also the S&P 500 monthly chart was, again, back in that early 2018 period. So that comparison holds here as well. The uptrend was not this explosive then, but it had the similar setup as well in the MACD histogram, with it kind of deteriorating over time, right? That's a loss of momentum. And then the monthly stochastics that you see there in the bottom window, notice that downturn. It's not great. And it's definitely really commonplace right now among technology stocks. So we arguably haven't seen very significant downside yet, but we're seeing a negative impact to the monthly stochastics that would suggest that with this DeMark signal, we could be getting into the implications are usually for about 9 months of potential corrective price action. That doesn't mean it goes down all the time, but sure. Perhaps it's range bound.
No, a lot of the growthy stuff has started, sort of led the way lower, and we're, everything's kind of down today, but we've seen this sort of rotation away from some of the growth leadership previously. We have Amazon up here next, making new highs earlier in 2021 and now making swing lows. What do you make of it at this point?
Well, I love this as an example of this cloud model yet again, because you notice that Amazon in its last sort of 2 major, actually even 3 major corrective periods, discovered support around the cloud boundaries. So this breakdown below the cloud, which is now decisive, is important. It's the first time it's been below decisively since 2015. And it increases risk that this is really indeed sort of a bearish reversal for Amazon. Next support you can see there, we're watching a Fibonacci retracement level of roughly 2950. But look at that MACD as well. It had been elevated above the 0 mark for some time. And we give more weight to the crossovers in the MACD, but you don't want to see it go into negative territory like that.
Katie, we have to leave it there. Listen, I really appreciate you coming on, sharing some really good charts to help us try to put all of this into proper perspective. Happy New Year. Thanks again for coming on. We'll talk to you again soon.
Sounds good, Dave. Take care.
That's Katie Stockton. Katie's the founder of Fairlead Strategies. She did just recently create a new newsletter, fairleadstrategies.substack.com, to check that out. She does a great job, and I've followed, known Katie and followed her work for a number of years. The cloud model is one. Anytime I bring Katie on the show, I make a note somewhere, look at cloud model more often, because it's such a great reminder. That's a traditional Japanese form of technical analysis, has a number of different techniques that are sort of all wrapped into it. But at times in my career, I've spent time on Japanese trading desks where it was all the Ichimoku cloud, the cloud model that she was referring to. Worth looking at our chart school section of the website, by the way, if you're not familiar with what I just described, because it could be an interesting additive point to your process. Let's continue on with our next segment, Getting Sentimental. We love to check in on some of the market sentiment readings. A lot of them update weekly, sort of Wednesday into Thursday. And so Thursday is a really good time to check in and see where some of the indicators had come off. We'll start with the VIX, and Katie did a great job of describing the volatility environment. So I don't want to beat it too much more than that. But just worth noting, obviously, 2021, by historical standards, sort of a mid-range sort of volatility. Just looking at the last couple of years, 2019 relatively low. She mentioned 2017 also very similar, pretty low volatility, and then 2018 you saw volatility spike as it was a choppy market environment, relatively speaking. We might be seeing a similar sort of pattern here, a period of lower volatility followed by a period of higher volatility. And so far in 2022, we've gone from around 17 at the beginning of the year to now hitting 25 and potentially eclipsing that. If you look back at the last 8 or 9 months, the VIX above 25 has been a fairly buyable dip. We saw those 3 times really after the first quarter of 2021, once in May, second time here in September, and then the third time at the November, early December low. So again, the open question, when the market does what it's doing right now, a pretty significant drawdown, volatility spiking, is this that buyable dip or something deeper? And again, my concern with charts like Amazon and others that we could look at, I'm seeing a lot of distribution. I'm not seeing this is the time to be jumping back in. I'm seeing a lot more weakness than strength, and wouldn't be surprised if we go further from there. But so far, the VIX right at 25, which puts it right in a relatively low number of observations for the last year. Now, survey data is another way we can try to make sense of the markets and understand how people are voting with their voices, right? When they're asked, are you bullish, bearish, or neutral? How are they responding to that? Sort of a continued deterioration in the AAII survey over the last 3 weeks. 3 weeks ago, when we talked about this, it was almost 40% bulls. Now that's been halved. It's to 21%. At that point, we had about, we'll say 32% bears, and that's increased to almost 50%. If you look at this purple horizontal line, you can see it is incredibly rare that we have over 50%, over half the respondents being bearish. This is super not common. And when it does, it usually means the market's in trouble. The times when this has happened most recently have been in the deeper drawdowns, like February, March 2020, back here to late 2018. Early 2018, not as negative, but by late 2018, you saw a real negative swing in there. We also have one of the lowest bullish readings that we've had really in the last 5 years. That's what the horizontal line is telling you. So while these things on their own don't tell you anything in particular necessarily about market direction, it does tell me we're showing conditions similar to some fairly negative trends in market history. By the way, if you look back at look at the bottom panel, which is the spread between bulls to bears, you can see this 25% outweighing of bears over bulls is also incredibly rare. And you can see that it's some of the major pullbacks that we've seen in the last 5 years that have seen that particular situation. The name exposure index, from what I can see, is similar to what it was last week. I'm going to check with our data guys to see if that's to confirm that that's true. But so far, it looks like there's not a huge change in there, which would tell me that money managers not taking a lot of action. I'm actually surprised if that's the case, but that's what the data is. That's what the data is telling me at this point. So at this point, it's not really anything significantly negative. You had a euphoric reading about 2 to 3 months ago. From there, it's been lightening up, but not as negative as it was back in early December, the last time we had a push to new highs. Sort of an interesting contrary move to what you might expect there in the name exposure index. Finally, the put call ratios are worth talking about. The last couple of times we've talked about, it's been more mid-range. for the put call ratio, but you can see it's actually rotated to the upside in 2022 so far. And if you look at where we're at now, you can see it's pretty rare that we're at this peak, this level in the put call ratio. And again, this is looking at the CBOE. It's looking at total put call ratios. It's not just equity options, but index options, and looking at positions on put contracts versus call contracts to get a gauge of overall bearish or bullish positioning. And there's some wiggle room with how we can interpret this, but overall, it's worth noting with the put call ratio being at 0.95 and being, moving certainly clearly further and further to the upside. You can see that this is actually, and by the way, I'm smoothing this out. So the pink line we're looking at is a 5-day moving average of that ratio. The raw data is there in gray, which is really, really choppy. So I'm smoothing it out with the pink line just to make a better historical comparison, or an easy historical comparison. You can see we're at similar put call ratios to where we've been on some of these major pullbacks going back in history. So certainly setting up here based on what we've seen in the last couple years in a similar level to previous drawdowns. You're seeing that here on the equity only put call ratio as well, just above 0.55. And again, that's pretty much one of the lower levels we've seen since this big spike in the put call ratio that you saw around the February-March 2020 market sell-off. So again, at this point, these indicators are lining up pretty well with historical pullbacks. The problem is if we would continue to accelerate from here, we very quickly look less and less like viable pullbacks, and we look much more like a period of a higher probability of a deeper correction. That's it for our look at market sentiment indexes. Let's wrap today's show and go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is looking at the breadth by cap tiers. We talked about this in our market recap. We hadn't looked at this breadth measure too often in the last week or two, and I just wanted to update on it. The S&P certainly pulling back, the NASDAQ pulling back. You can see all of these advanced decline lines going lower, which makes sense. This isn't updated quite yet for today's close. I would imagine all of these are going to take a further hit and move further to the downside. Now what you have to do is start looking at where they're at relative to key support levels, right? So 3 out of the 4 have already broken their 50-day, with the S&P probably most likely breaking that today, which means you have to start looking at the previous swing lows. I'll be eyeing that December low for all 4 of these to see if they're able to hold. At this point, all of them are holding. If any of them would start violating that low, I'll turn it bright red and tell you it's starting to get a much more negative feel to the market. Now, this is coming after that bearish divergence that you saw, particularly in the NYSE advanced decline line from November to January. Chart number 2 is PayPal. We have a lot of earnings and a lot of movements in stocks going on. When we were talking with Katie Stockton earlier, we were talking about some growth stocks, and particularly we looked at Amazon, but there are others I know I would have loved to chat about with Katie. And PayPal is an interesting one. When we think about Fibonacci retracements, this is a stock that had a clear 38.2%, which we gapped below the 50% level, which has now served as resistance. And now we're right down to the 61.8%, which lines up from lows back in 2020. And what's interesting about this is we're right at potential support. What's concerning is if we break 169 and follow through, there's not much below there in terms of potential support. And it indicates or suggests potential return back to the previous lows. I just put a video on my own YouTube channel called Market Misbehavior earlier today, digging into that Fibonacci analysis a little bit further. So check that out. Finally, Peloton in the news today, ceasing production of their bikes, at least for now, temporary, I think for now, but and the stock is coming off pretty good, down about 24% into the close on that news. And the reason why I wanted to highlight this as a technical example is while the news may have surprised any of you today, while the significance or the significant drawdown today certainly may have surprised you, the direction, the trend, hopefully has not surprised you at all. You see how it's broken clear support. It's broken Fibonacci support. It gapped below it. It's been in an established downtrend. And this is why I think these charts are best to avoid, because of the danger of what you saw in Peloton today. Those sorts of movements are the fundamental recognition of the weakness that we've seen in price. I think investors have realized that there's some weakness there. Folks, that's our show. Special thank you to Katie Stockton from Fairlead Strategies joining us from Connecticut. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.